Every single stock chart you will ever look at is made of these candlesticks. And if you cannot read them, you are trading blind. When you look at a candlestick chart right now, do you actually know what every single piece of it is telling you? Drop your answer in the comments, because by the end of this video, you will. Welcome to Alpha Breakout Lab, free trading education for everyone. This is episode 4 of the Trading Fundamentals series. Today, we are covering one of the most important skills in all of technical analysis: how to read a candlestick chart. This is the foundation of everything. You cannot use moving averages, support and resistance, or any other technical indicator without understanding this first.
A candlestick is a visual representation of price movement over a specific period of time. Every single candle tells you 4 things. The open, where the price started when the period began. The close, where the price ended when the period finished. Where the candle open and close is the body, and within the body is the size, which tells you how far price action moved from open to close. The high, the highest price reached during the period. The low, the lowest price reached during the period. These 4 data points are captured in every single candle, whether you are looking at a 1-minute chart or a daily chart. The candle always tells the same story. The thick part of the candle is called the body. The body shows you the difference between the open and the close. A green candle, sometimes called a bullish candle, means the price closed higher than it opened. Buyers were in control. A red candle, sometimes called a bearish candle, means the price closed lower than it opened. Sellers were in control. Simple rule: green means buyers won that period. Red means sellers won. The thin lines above and below the body are called wicks, sometimes called shadows or tails. The upper wick shows how high the price went before being pushed back down. The lower wick shows how low the price went before being pushed back up. Long wicks tell a very important story. A long upper wick means buyers tried to push the price higher, but sellers pushed it back down. A long lower wick means sellers tried to push it lower, but buyers stepped in and pushed it back up. The wicks show the battle between buyers and sellers. And understanding that battle is how you predict what happens next. Now let me show you the most important candlestick patterns every trader needs to know. The doji, when the open and close are almost the same price. The candle looks like a cross or a plus sign. This means the market is undecided. Neither buyers nor sellers are in control. After a big move, a doji is a warning that the trend may be about to reverse. The hammer, a small body at the top with a long lower wick. This appears after a downtrend and signals that sellers pushed the price way down, but buyers fought back hard. This is often a bullish reversal signal. The shooting star, the opposite of a hammer. Small body at the bottom with a long upper wick. This appears after an uptrend and signals that buyers pushed the price way up, but sellers fought back hard. This is often a bearish reversal signal. The engulfing candle, when a large candle completely swallows the previous candle. A bullish engulfing at the bottom of a downtrend signals a reversal up. A bearish engulfing at the top of an uptrend signals a reversal down. Pro tip: never look at a single candle in isolation. A candle only has meaning in context. Where is it in the trend? What did the previous candles look like? What is the volume doing? One candle tells a story, but multiple candles together tell the full story. Always zoom out before you zoom in. If this is helping you, hit that like button, share this video, and subscribe for more free trading education. The information you just learned in this video will be helpful in the next stage of using candlesticks. So, make sure to watch my next video that puts this new information to use. Now you know how to read individual candles, but here is how professional traders use them. Candlesticks work best when combined with other indicators. When a hammer forms right at a support level, that is a high probability buy signal. When a shooting star forms right at a resistance level, that is a high probability sell signal. When a doji forms right at a moving average crossover, that is a signal to pay attention and wait for confirmation. Candlesticks are not signals by themselves. They are context clues that confirm or deny what your other indicators are telling you. That is the difference between a beginner reading candles and a professional reading candles. Professionals use several indicators to make logical choices according to what the charts are telling them to do. The first step to reading charts is to learn candlesticks. With practice, understanding candlesticks will be second nature to you.
Subscribe to Alpha Breakout Lab for free trading education every single week. Visit alphabreakoutlab.com, where the tools, the education, and the community are all waiting for you completely free. Next episode, we go deeper into how to use candlestick patterns with moving averages to find high probability trade setups. Every failure made me strong enough to carry the weight of my success. Failures don't kill dreams. Quitting does. Builders don't sleep until the dream is real.